Welcome to Trading Research Group and a presentation I personally am looking forward to as one half of Trading Research Group that has not seen this material. Lee Harris is going to do today's presentation. Lee is a very technically trained guy in terms of IT. He's a former prop trader. He knows the markets as well as most people that I have met, and I've met a whole lot of people in 45 years. So without further ado, I'm going to turn it over to you, Lee.
Great,
welcome.
Thank you, Jeff. Thanks. So thank you and welcome everybody. We've got a really nice turnout today. My name is Lee Harris, as Jeff has said and introduced me. And what today is about is it's workshop 1 in a series of 5, which we're classing as an implementation workshop. And we're really focusing on trade setups that are based on market structure. Before we do anything else, I'm going to put up the regular disclaimer: you can lose money if you are trading. I think we all know that. I think we all know the risks. I think we've all experienced losing money, but this keeps us safe and clean. So the agenda for today is I'm going to spend a bit of time on the introduction because we've got a mixed audience here. We have made this first workshop accessible to non-TRG members, to give them a chance to see what trading research is about, see if the material in the workshop's of interest for them to join Trading Research Group. And I've got a bit of a balancing act to do between making things accessible to people who are new to Trading Research Group, also making sure that our current members gain something from this and their appetite is whetted for the next 4 sessions, which will play out over the next 2 weeks. So I'm going to spend a bit of time on the introduction. I'm going to go through what my objectives are through the delivery of the workshop over the next 5 sessions. I'm going to give a high-level example of one of the setups. I'm going to summarize what our workshop structure is going to be and also the schedule over the next couple of weeks. And I'm going to go through some prerequisites of knowledge and understanding around elements of order flow that are going to be necessary to get the most out of this workshop. Some of this material we've already covered within Trading Research Group, whether it's through the Slack chat or whether it's through various clinics, but I'm going to give kind of homework assignments that relate to material in our library and things to study before the next 1 or 2 sessions. But I'm also going to give an interactive walkthrough with me talking against this material again from slides, which will give the opportunity to have a recap for people that are familiar with material, but also give a sort of high-level introduction, high-level understanding to people who are new to Trading Research Groups. They can also understand a bit of what we're about. And we can dive deeper into that towards the end of the session. Then, of course, we'll have some Q&A. So, in terms of the introduction, what is this? This is the first session of 5 scheduled sessions of a workshop about a bunch of setups that I have identified and I use to trade every day. As with any session that's the first session of kind of a multi-session series, this is really going to be about overview and structure and setting expectations and saying, here's what we're going to cover. If there's anybody from outside Trading Research who's come to this thinking, I'm going to walk away and I'm going to have a whole batch of new skills in my pocket, and on Monday, I'm going to make a fortune, your expectations are wrong. It's not realistic. In an hour or 90 minutes, I can't teach you full understanding of a given trade setup that's going to work all the time. What I'm giving is, here's a flavor of what we're going to cover, and here's some homework, and here's the scope of what we're going to do. So I'm setting this out now so that in 90 minutes time, I'm not going to get anyone complaining to me of either, oh, I knew that all, or you promised me this and I got nothing out of this 90 minutes, is a waste of time. We are setting expectations here of what we're going to cover and giving a flavor of some of it. I also want to make clear, this is intermediate to advanced level stuff. Sure, not everybody understands order flow or has a deep down understanding of order flow, but if you are coming to this material with a very low understanding of futures trading, a lot of this is going to be over your head, quite frankly. Yeah, the session is recorded, so obviously there's going to be ample time for review. But this isn't a entry-level workshop teaching you how this stuff works and why from base level. the majority of members within Trading Research Group have traded for long enough to find their way into desiring a good understanding of order flow. There's lots of free material out there on the internet. At my commercial emoji trading site, I do a total non-proprietary introduction to concepts within order flow, and we're not going to spend much time on recapping these base level concepts. Some of the jargon is assumed that you know it. This is really about application of knowledge and how you can tie things together in a good way. So I want to make clear this is pretty intermediate to advanced level stuff. We assume that you're traders that have got a grasp on this stuff, and you want to advance in its application. In terms of who's here, as I said, we have got quite a large audience today. There is a bunch of people who are current Trading Research Group members, and then from the opening out of this session, both through Jeff's Facebook group, Surfing the Markets, and also through emoji clients, past, present, prospective, we have some non-members. And I'm going to do my best to make sure there's value to everybody. And there's a balancing act in terms of making sure that this is good use of everybody's time. But for non-members, what I want to make clear is that the next 4 sessions are available to members of Trading Research Group. So if you like, this is a sales pitch, say, come join Trading Research Group. In terms of what that entails, membership is $99 a month. The group is co-founded by Jeff and myself. We're both full-time traders. We have got quite a long backgrounds from different routes into trading. Jeff focuses more on being a fantastic scalper. I like looking at structural, very mechanical type setups, but our skills and our abilities converge into each other's camp. And we are both strong advocates of reading the volume and applying understanding of order flow into how we trade. And that's, I think, why we complement each other well in terms of being able to share knowledge and develop as a group. And in terms of this group's ability, I mean, what I'm really pleased to say is, we had 2 group members who got funded by trading evaluators this week. One by Top Step Trader, one by Earn to Trade. So as a group, the people within the group, some are trading full-time, for some it's a serious part-time activity, but everyone is serious about their trading. And they're putting the money where their mouth is, but they're applying what we advocate and they're getting results from it. So what is really pleasing for Jeff and myself is we are seeing people who are taking on concepts, taking on knowledge, interacting with everybody. And our concept is, all boats have got to rise. The whole is better than the sum of its parts. And seeing people become consistently profitable and getting funded where they're choosing to go down the evaluation route is really great, and it's real. And I know that we have got enough people from our group here that if people have doubts, they're asking things in the chat about, is this real? How many of you trade for a living? Da, 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 da. I can expect dozens of answers coming back from our members, which are going to be positive. And really what our group is about is it's about applying process to your trading. So many people who, quote, trade, come to trading with this belief that they're going to be really successful at this endeavor, which is incredibly hard. And what I find amazing all the time is they don't get a deep understanding of what they're doing. They're not that capable of using the really complicated software that we all use to trade, yet magically they think they can use really complicated tools to undertake a really hard endeavor and make money. So we aren't looking to feed the dreams of these types of people. We're saying, if you are serious about trading, then how do you apply process to what you're doing? And how do you build your toolkit, including trade setups, in order to be a consistently profitable trader? And neither Jeff nor I purport to know everything about this. And that's why we're doing it. It only takes one good question from members to get us thinking about something in a different way. And also, in order to be able to educate and share knowledge well, it means that our understanding has got to be really clear. If we can't explain something clearly, it means we don't understand it. And I've found this both as a developer of tools and also as a trading coach, that the process of either developing a productivity aid or a tool or an indicator, don't like that word, or putting together workshop material or one-to-one training, it means I've got to have really good from ground level understanding of what I'm doing, otherwise I can't articulate it or communicate it well. So what we don't do in Trading Research Group is call trades or price levels. We're not a Thuru live trading room. Totally not interested in this. We don't use any price-based indicators, RSI, MACD, moving average, don't care. It's all nonsense. And nor do we propose that being consistently profitable as a trader is easy. It's really hard. Most people that come to this will fail. And why? It's because they're not serious, or they're not clever enough, or they're not open to learning in the right way. You know what? Good. These are the people on the other half of our trades. Without them, we're going to have a really hard time. But what we do is we meet regularly online to develop our skill sets together. We generally have a start of week kickoff every Monday, and at least one other session during the week. It might be educational content, it might be an ad hoc live session around NFP or FOMC, it might be tape reading, it might be a round table. And we're scheduling our next round table at the end of this month, where we're going to have a group chat around trading combines and psychology. We utilize and we advocate a process-driven approach to developing trading setups. We're going to look at trading setups today. We have a Slack workspace so that there can be 24/7 chat and interaction. Jeff's based on the West Coast in the US, I'm in the UK, so we've got what, 16, 18-hour time zone coverage, plus Jeff doesn't sleep. He's a polyphasic sleep advocate. So generally, there's always a degree of founder involvement in the chat as well. We are always looking at new ideas, both in terms of trade setups and also in how we use our platforms. I tend to focus my time right now on Sierra Chart. Jeff uses NinjaTrader and Jigsaw Day Trader. We are platform agnostic. If a better tool comes along, we will embrace it and we will use it. And actually, you can trade well with any decent tool. It's not the tool that makes you good, it's your understanding and your ability to select and use the right tool that will be part of your success. But we've got reasonably broad coverage of popular trading platforms, but our understanding of these platforms is really high, and we are able to squeeze these platforms hard and make them do clever things. And in fact, in session 2, on Wednesday, I'll be going through some of these things that I'm doing to underpin these setups. And as well as our scheduled meetings, events, we do ad hoc events, and everything's recorded, and we put it in an online library that's available to our members. We've got probably 50 or 60 videos in there now, over 400 hours of content. Vimeo is getting slower and slower as we upload, but we share everything that we do. So it's a pretty big resource. It's $99 a month, so I'd encourage anybody who isn't a member, give us a whirl. It's 2 ES points, and if you sign up at the end of this, you can have the pleasure of my material over the next 2 weeks anyway. And if I'm not worth $99 for 5 hours of your life, then, oh, then what is? So that's what this session is today. Who's here? And then to the questions. Someone asked this last time we opened up a public session. If you're so good at trading, you make so much money trading, why don't you do it all the time? Why are you selling education? Why are you selling tools and indicators? I do trade. Jeff trades. We each trade. Yeah. If I didn't trade, I would not have the material here to share with you. Why don't I only trade? You know what? It's boring. Why is it boring? Because I know what I'm doing. I had the experience in a prop firm in 2014 in London, where I realized I didn't enjoy getting up at 4 in the morning to get on the flipping slow train, the first train of the day from my nearby station, to get to my desk at 7 a.m. to sit in front of a screen from 7 a.m. till probably 4 p.m. surrounded by people I didn't really like who were distracting me. And I aim to trade as little as possible. And you'll see that from the approach I take to some of my setups. Now, the attitude I take on trading is if I can focus for 2.5, 3 hours a day, probably at certain times of the day, or being alerted to opportunities by my platform, then that's fine. And it gives me time to do other more interesting, more productive, more balanced things. So yeah, I do trade, but for me, as a software developer and having other interests as well, I like to regard my trading as a paid way of doing research, because if I see an idea, I'm very interested in spending other time researching it. I might be able to productize that idea into a tool. If it's a valid idea, I can certainly communicate it through knowledge. And what I find funny as well is the same people go, if you're so good at trading, why don't you do it all the time? Why are you charging me money? That's not my food voice. That's my resentful client voice. They also go, well, can you tell me how to do this? Can you tell me how to do this? Can you tell me how to do this? But they don't put any value on the knowledge. And there's a paradox there that they're skeptical of anybody who has knowledge of a product to share, but they also want the knowledge, but they don't want to pay for it, and they're skeptical. And yeah, there are a lot of snake oil salespeople in this business. But to get rid of the question of why don't you do it, I do it, and I'm sharing that knowledge. You can qualify whether or not I'm talking sense, or whether you like my educational or communication style. If it doesn't fit, that's fine. I'll go back to my trading income anyway. So that's the end of the introduction. For our TRG members, you heard one of my character voices, not as entertaining as Jeff's, but there we go. So what are the objectives from this workshop? My aim is that you learn several structural trade setups, which are sometimes time-based, based upon statistical analysis of the frequency of structure-based events, which might be market profile concept-based occurring. And I've emphasized some of the words in this objective in bold, because these are really quite key to what we're doing. Let's think first of all about the importance of a setup and having a playbook of setups. The people that are not serious about their trading or don't have a process-driven approach will very often, and I've seen this in coaching clients early on, I will say to a new private coaching client, tell me how you go about your trading day. And so I'll turn on my computer, bring up my charts, and I'll look for something. God help me, it might be moving average crossover or something, but they pull up a chart of whatever their preferred period is. I don't care what the period is, it's wrong. 10 range, 4 tick reversal, 5 minute, whatever it is, it's wrong, it doesn't matter. And they sit and they wait for something to occur and they take the trade. And that's a lack of process. They think that their magic flashing indicator, what was it? Somebody suggested it might be the superpower 9 indicator. That's it. They think that the green arrow from that is a good signal, or maybe they even understand some order flow patterns. And based on purely that occurring, maybe they've looked at their daily charts as well, or there's some trend lines, they'll trade. But there's no process and there's no structure to what they're doing. And just because an indicator flashes red or green or blue is not a reason to take a trade. Trade setups work as filters for us to consider taking a trade within the framework of this setup. So what I'm doing in this workshop is we're going to explore half a dozen conditions that occur within market structure, which then allow us to look closer at what's going on in the order flow to consider taking a trade within the framework of this setup. And the beauty of making this structural based is it gives us price level boundaries to assess and qualify the opportunity. What I also like about working on market structure, especially when it's based around concepts of market profile, is it allows us to do things that are based on time of day. Now, even though I work for myself, I still feel like I've got too much work going on. As I'm sitting at my desk now, I'm looking at my software development to-do list, and I've got a year, 18 months of project work ahead of me. I'm too busy for my available resource. Now, if I spend too much time trading, I'm detracting from other activity. And I think for everybody here that is using trading alongside either a full-time job or their own business, they can probably relate to this. We've all probably had the experiences of, I'll put the trading screens on, and before we know it, 4 hours have gone, and you start profitably, and then maybe you gave half back, you gave all back, or you, oh God forbid, you ended the day negative after being up, and you end the day feeling really annoyed, and you think, what a waste of time, and it's detracted from your productivity. So one of the things I like about potential setups that can happen at certain times of day is I know that between 9 and 9:30 Central Time, I've got one job to do. So I can mentally partition that time of day, my job is to do this. And my job is to identify and execute the trade within the framework of this setup successfully. Equally, if I can't identify it, or actually it doesn't occur, that's fine. I've wasted half an hour, and not trading the setup that wasn't there is also good, but I've allocated my time out. So now we're able to turn our trading activity into, at this time of day or at this time of day, I'm looking for this particular event to occur. I know how to identify it and I know how to execute on it. Now, if we can combine a few of these into a playbook, we've made our trading activity very procedural, and we can treat it like a job, and we can fit other things around it. Those other things might be research of new setups, and that's valid. It's a trading career. It might be our day job. It might be another business venture. I know, we've got several members in trading research group that run other businesses. So it's about how can we make the best use of our time on this trading endeavor without the risk of over trading or wasting time or doing things that are out of our plan. And that's the importance of a setup. But for a setup to be good, we want it to occur a lot. We want to be able to gain a repeatable edge from it. So I like to use statistics to look at how often certain things occur within the structure of the market, because then I can apply my time based on 2 or 3 scenarios which will play out, and I've got a sense of how often they'll play out. In terms of what we're going to do with these setups through the next sessions, primarily I'm going to be focused on ES and CL, purely because they behave very nicely in structure. Sure, over the past 3-4 weeks, as we've had all this COVID-19 volatility, things have changed. The nature of the way these instruments are trading has changed. But as I go through some of the stats, what I will be doing actually in a couple of the later sessions, I think session 3, session 4, on actually setups, I'm going to be doing a bit of comparison on what was the last month like statistically on these structures compared to the last year. And let's look for changes, because nothing is static when we're trading. I really want you guys to come away from this with a mindset of, okay, I see how Lee has gone about developing setups and building a process. I now understand this mindset and I can start to explore in this way on my own. I am not giving you a here's how I'm going to become a gazillionaire in 3 weeks or 3 months on a plate. I just have to do exactly this. We're all going to implement this differently. Much like university, I'm aiming to give you a way of thinking about developing your own playbook and executing setups by giving you a starting point of half a dozen setups that you can explore. And I'd encourage you to explore them and qualify them for yourself. Be skeptical of what I'm telling you. Now, I will use ES and CL, because that's what I mainly concentrate on, but for other markets that are, liquids, have sort of medium thickness in terms of how they trade, you can also look at these concepts on gold, on the bunds, on Euro stocks if you've got patience, on the bonds. What you can also do is use the approach which we take on ES as a directional guide for the highly correlated equities. So if your preferred poison is NQ or the Russell, then absolutely no reason to not look at the setups around ES as a framework. But if you enjoy scalping NQ, picking up $20 bills as we put it, what I'm giving you here is a way of looking at what are the broad equities doing and where's the opportunity, but you could be executing on a different instrument in a different style. So I'm coming at this from, here's how I do it, but you can adapt and mold these concepts to your own preferences. So that's about the structure and the setups. What we'll also do is understand how events in the order flow are used within the frameworks of these setups. And I'll go through this a bit more because I'm going to give an example walkthrough of one of these setups. And as I alluded to, I want you to gain a mindset and methodology to research new setups. Nothing stays constant in trading. These setups are statistically sound, have been for a while. We'll see how they've changed over the past month as the volatility has changed, but it's about a way of thinking. I remember when I did my degree a long time ago. I've got a BS in computer science, and everything is obsolete now. I remember at the end of my degree thinking, what have I actually learned? And none of it felt particularly relevant, but I was aware I could think better and I could analyze things better. And what I'm aiming for is you come away from this with the view of, okay, here's how Lee has gone about building his trading business in his playbook. You're able to think and structure your own trading business with similar concepts and in a similar way. So there is no magic answer out of this workshop, but there is an approach to how you go about trading. And if I can deliver that in the next 4 or 5 sessions, and some of you go, yep, you fulfilled those objectives, and we'll check this in the last session, then I'll pat myself on the back because I've delivered what I set out to do. So let's go through an example. There are 6 structural setups which I'm going to cover in this workshop. One of them is called IB range, initial balance range. And here's a simple, this is actually out of my charting platform. The orange arrow isn't, but what this setup is about is when the instrument has a weak break of the first hour's high or low. So that's a range of prices formed in the first hour, commonly referred to as the initial balance. It's how we trade a weak break of the first hour's high or low to the opposite side of the range that has been formed. Now you can see that here, the third bar along, it broke the high of the first hour, and then over the next couple of hours, it traded all the way back to the other side and it went further. I don't care about the going further. What interests me is qualifying what makes a break weak and knowing the statistical framework that says, okay, if there is a weak break, and we'll get into what a weak break can be, how can I then look for an optimal entry knowing I've got a decent opportunity of capturing all of that first hour range? Now, of course, the trade's going to start, I want an optimum entry. And as Jeff says, every trade starts as a scalp. Of course it does. I don't want a rubbish entry where I might take heat or be worrying about my risk. But I'm mindful of the potential based upon statistical analysis that I actually have the opportunity of a really nice intraday swing trade that I could scale into or trade around, or just leave one lot running, knowing where my ideal exit is, or maybe leave 2 lots running. I'll take one off just before the target and let the other one run as a runner and see what happens. So that's what this setup is. Why do I care about this? And here are some stats which I put in the TRG Quant Lab channel a while ago. We had a bit of discussion around it, but it was quite informal. So I'm going to present it here again. This is also for the benefit of people who are joining us as non-TRG members during here. So the table on the left is an analysis for all of 2018, where we're looking at ES and we are counting how many times ES broke the initial balance range, so the first hour's high and low, on one side only, both sides, or neither side. Well, neither side's nothing, 2%. Not interested. On the rare occasions that occurs, so what, 260 trading days per year? 4 or 5 days it doesn't do that. We can probably predict when those are. It's probably what, Christmas Eve, it's the weird half days. Let's forget about that. But what we can see is one side break happens the majority of the time. So that gives us good basis for a bread and butter trade. And we'll go through this as a setup in one of the later sessions. And then it breaks both sides nearly 40% of the time. Or let's put this in terms of our trading week. We could think that 3 days out of 5, ES is going to break one side of the initial balance. 2 days out of 5, it's likely to break both sides. So at close of play on Wednesday, we're immediately in a position to think, what could happen on Thursday and Friday based on this? So it's very interesting to look at the behaviors relating to market structure of the contracts that we trade, because you start to understand the personalities and behaviors. of the markets that we're trading, and you can then start to look for events that repeat and how to take advantage of them. And what got me into this way of thinking was, during the 2000s, from about 2002 to 2014, I used to run a consumer electronics business, and I would go to the CES convention in Las Vegas every January. Between that and other various events, I've probably visited Vegas about 35 times. That's bonkers. And after about 3 or 4 years of going there, I thought, why am I paying $20 for a pre-dinner cocktail when I can get it for free if I play blackjack? Now, my grandfather was a bookmaker. He was an on-course bookmaker and ultimately had a betting shop. And he drummed into me, never gamble, never gamble. But I knew that, blackjack was all about probabilities, and if you didn't play on a table with continuous shuffler, if it was a shoe deck, then it was possible through basic strategy to understand the probabilities, and you could gain a very slight edge if you learnt card count. So I learnt basic strategy, I learnt a simple card count, the ace-5 count, and I would no longer pay $20 for a cocktail. I'd sit and play blackjack perfectly, knowing I had a 0.25% edge, and it was just about being good, applying the rules, and I'd get my free drink. And when I started looking at trading seriously, I thought, how can I take this same process-driven mechanical approach to trading? Because what seems to happen is the market opens, it goes up and it goes down over a period of time. Let's call this the first hour, the initial balance. And then it breaks one side and it might come back in and it keeps going, or it doesn't break one side or it breaks both sides. And that's what got me very interested in the statistics, because I thought, if I can see repeatable behavior, then I can start to understand setups and exploit this repeatable behavior, because I can build procedures around what to trade and how. So within this setup, we know that 37% of times during 2018, ES broke both sides of the initial balance. Let's start to analyze the nature of these breaks. Now, in the second table, what I've done is, for the same data set, 2018, I have looked at what's the frequency of different traversals of the break. Now, obviously, a one-side break day only breaks one side, the clue's in the name. But on a two-sided break day, we generally have a weak break followed by a stronger break later in the day. So maybe are these based on no, this is all based on Central Time. So it's ES 8:30 Central to 9:30 Central is the initial balance. I always look at my charts and the contracts based upon the exchange time of the exchange's location where the contract's traded. So for me, ES opens at 8:30 Central. So in this second column, I've analysed the days where both sides of the initial balance have breaks, and I'm looking to understand the frequency of the weak break according to how weak the break is. And what we can see is the weak break is 4 ticks or less 25% of the time, 8 ticks or less 18% of the time, 12 ticks or less 16% of the time, and so on. And the 18% of 8 ticks isn't including the 25%, so we can accumulate it up. So what we can see is that 25 plus 18 plus 16, so that's what, 45, 43, 53, 59% of the time, we will have a weak break, or we can say a weak break is 12 ticks or less 59% of the time. So then let's compare these traversals to a one-side break day. Now, what you can see is that the break of the initial balance tends not to be weak on a day where only one side is broken. So we've got 2.5%, 4.5%, 4.5%. So it's what, 9, 10, 11.5% of one side break days show a break of 12 ticks or less. Whereas we have got 59% on two-sided break days. So now we've got kind of a 5-to-1 edge. If we can identify what is a weak break, then we know we've got a decent likelihood of going all the way back to the other side. But the question is, how do we identify a weak break? And you go, oh, I know what I'll do. As soon as it breaks, I'm going to fade at 4 ticks or 8 ticks or 12 ticks. Well, you could do that, but that's a bit unsophisticated. So that's why we need to look deeper into what's going on. But just to look at these stats pictorially, I fired my platform up this morning. This is February. And what I've got here, this is a 30-minute chart. The solid lines are the day session high and low. I'm only showing the day session. The dotted lines, the first hour high low, the initial balance. And I told the platform to paint the background black when the session high and low has exceeded the initial balance high and low, but only do that if the traversal of the weak side, so I've said look for the minimum of the weak side break or the strong side break, if the traversal is 12 ticks or less. So this is a way, even without building a database of all these sort of behaviors, of being able to look back in time and just see, okay, what sort of patterns can I see in the market structure? So here we've got what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We've got 11 trading days, which are highlighted. Also 11 trading days in this chart, and we've got 1, 2, 3, 4, we've got 5, which are meeting these criteria. So this is kind of turning the stats into the reality. And when you start to step back and look at these 30-minute charts, which are analogous to TPO market profile in terms of what we're evaluating, we can start to see, okay, the theory holds true, and I start to get some rough ideas on how I might be able to work with this. So you could naively say, all right, I'm always going to, when the initial balance is broken by 4 ticks, I'm going to trade the other way. You're going to get run over. You're going to get run over if you do it at 8 ticks or 12 ticks. And why are you going to get run over? Because ES breaks one side 50% more times than it breaks both sides. So you can't just make this decision based on price. You've got to be able to qualify the nature of what's going on. So you could say, well, I know that 2 days out of 5 it will do this. So if I've seen 3 single side breaks in a row this week, then I'm going to assume I've got a likelihood of 2-sided breaks coming up. Yeah, you could, but I think you're gambling. We can be a bit more sophisticated in our analysis, and that's why we use order flow. So how do we actually go about execution of the opportunity that is presented by these trade setups? So let's explore the idea that there are trade setups, a framework in which we might execute to a plan, versus triggers for actually doing it. And I like to think of the process of trading as archery or firing a gun. I particularly like trades where I've got a target in mind. I'm not dog with a bone. I'm not going to, I want to exit this target or nothing. No, I'm not interested in that, but I'm very interested in there being a likelihood of us trading to a particular area. So that for me is aiming at my archery target or pointing the gun at the unwilling victim. Then I'm looking to pull the bow back. And that for me is identifying favorable conditions within the order flow. I'm not blindly entering because, oh, we're 4 ticks away from the initial balance high and the stats are in my favor, because they're not. I actually want to look for conditions that make the statistical hypothesis I'm working from favorable for me to take. So I want the crowd to be moving in that direction so I can join in. So I'm looking for the order flow to be favorable to the plan which I'm aiming to play out. And then I need a final entry trigger. And for me, that could be based on changes in delta, changes in liquidity, could be as simple as we moved away from here and things like, right, let's do it. And I will use these triggers both for reversal setups or continuation setups. But the setup on its own is not enough. We need a trigger in order to take the trade opportunity that's presented by the setup. So liken the process to archery or firing a gun. So how we're going to deliver all the material that relates to this is against the following schedule. session 1 is today, and I've set out the objectives. I'm going through the structure now, and after this chat, I'm going to go through some of the prerequisites and your homework. Our next session is on Wednesday. Everything's always going to start at 9 o'clock Pacific, 11 o'clock Central. So on Wednesday, before we even get into the setups, I'm going to review the data elements that I use in my decision making. I'm going to show you how I set my charts up, my point of view, but also discuss alternatives to looking at this data in the way that I do it. And it may be because you don't like the setups of the indicators I'm doing. It may be I'm using a feature which your platform doesn't support. The final specifics of what I'm looking at are not carved in stone. I'm going to be going through, here are elements used in my decision making, and here's how I try to visualize them to make it easy for me to assemble all of these in one place and then make a decision. And I feel it's important to go through that as well as the prerequisites today before we look at the setups. And even though this might seem back to front, there's no point going through these setups if we haven't got the tools in place or the understanding of how to make decisions in order to execute these setups. So our first 2 sessions are relatively heavy, then we're getting onto the application of this information within a framework. So in session 3, which is next Saturday, I'll go through our first 3 setups, which are all what I refer to as inside-out setups. We allow a range to be established, and then we are looking to trade from inside that range somewhere to the edge of the range. In session 4, I'm going to introduce 3 more setups, which are not inside-out setups. Some of them are outside in, funnily enough. Some of them are neither inside out nor outside in. Then on session 5, we're going to have a wrap up where we check where we've got to versus the objectives, discuss how we can work with this framework of understanding, give you some ideas on how to do your own research, and also do an open Q&A around the whole workshop. But obviously in each session, we'll do specific Q&A around the material that's been presented. Oops. Okay. So the prerequisites in order to really understand how to execute these setups. The graphic on the right for people that aren't members of Trading Research Group is our members library, which is hosted in a private area on the Trading Research Group website. So we have various clinics, and clinics are typically 1 session, 1 to 2 hours long, where we explore specific concepts. And I've run some clinics in the past looking at various order flow concepts, and I've highlighted in green for our members the clinics which I've delivered in the past, which I would like you to rewatch as a priority. And then the yellow one is recommended if you have time available. So there's 4 clinics to review. But I'm also going to recap these concepts here for the benefit of those who aren't yet Trading Research Group members, but also the opportunity that we can explore these in the Q&A towards the end if need be. So the order flow concepts that I am using in my evaluation of how to execute within these setups are pullback and pullback delta, delta at price, which helps us identify absorption, meaningful patterns within the order flow, specifically a pattern I call the price rejector, but also the delta captured in the price rejector, and unfinished business. So for me, these are my tells and these are my triggers in order to take a trade within the framework of a setup. But you can also use those that you relate to very well too. So for example, if your main trading style is reading the DOM and nothing else, and you're looking at the current and recent traded volume in the DOM and probably keeping an eye on the delta of those columns that you're resetting based upon your BABA, then you can use that as your trigger to enter a trade. So I'm showing you my way of doing it, which is quite structural, quite procedural, but you may go, you know what, I like to enter based on lots of imbalances. I like to look at positive delta on a 3-second chart. That's fine. But I'm giving you a process. But in order to play along the examples I'm giving, I'm going to be providing all of my examples using the order flow concepts on this list to illustrate how I'm making my decisions. So we'll do a quick walkthrough of these concepts now, so that there's a recap for TRG members, and so that people that aren't TRG members can leave today's session thinking, I haven't heard that before. I've learned something. So, pullback. Pullback is something I like to refer to as the auction within the auction. And this is, sometimes this blows people's minds, so I'm going to go through this as slowly and clearly as I can. What this graphic is showing us on the far left is a footprint, a candlestick, which is a 30-minute bar. So there's all the volume that traded within 30 minutes in this up bar. Now, we can understand that this 30-minute time slice is arbitrary, because all charts are wrong. But inside that 30-minute bar, if we set our platform to display 5 minutes, we'd have 6 5-minute bars, which I've broken out to the right. So the volume within the 30-minute bar is the sum of the overlapping volume at each price within 6 5-minute bars, or 2 15-minute bars, or 3 10-minute bars, or 31-minute bars. You get the idea. You know, all of these are arbitrary views. And the rotations within the 30-minute candlestick, we can visualize in different ways according to what we tell our platform to do. But actually, the market doesn't care about how we're looking at these rotations. All we can see is how much volume has been accumulated, and we can divide that horizontally using different algorithms, whether it's time or ticks or reversal. Now, if we look at the price level that is the top but one price level within the 30-minute bar, we see 361 by 591. So 591 contracts lifted the offer, 361 contracts hit the bid at whatever that price was. If we look at the corresponding 5-minute bars, then you can see that 591 contracts was made up in these 5-minute rotations of 548 contracts during the 10-minute candle and 43 contracts at the 20-minute candle. 548 plus 43 is 591. So that's how that volume occurred. So what happened in that 30 minutes? Well, on a 5-minute view, we went up higher, we wiggled down, we went up again, not quite as high, we went down, we went up. Those were the rotations on a 5-minute view. Now, the idea of the pullback is that for a given, typically longer term bar, we start tracking the volume as we retrace from the extreme of the bar. So on the right-hand side, we've got our 30-minute candle, then we start building a new candle as we come away from the high. So you can see the price level, the second price level to the top at the pullback, the print is 90 by 112. So what this is capturing is that after we traded up, as we tick down by one tick and maybe wiggled around, after that very topmost print, 90 contracts hit the bid, 112 contracts lifted the offer. Now, I like to use this idea of pullback on slower candles, typically 30 minutes, because I care about the rotation away from the edge. And we can start to read the order flow in the rotation away from what the extreme was on our longer term boundary. This candlestick, this pullback candlestick, is temporary. Now, the platform I use, Sierra Chart, it can display these pullbacks. Other platforms may, they may not. You can also take a more coarse view and just say, well, what's the delta? You know, what's the net of the aggressive buying less the aggressive selling on the pullback, to give you an understanding of the aggression of the pullback buying or selling. And that's a concept which we'll get to a little bit later on. But I want you to understand that if we think about the auction within the longer term auction, this is something quite important to consider when we are thinking about when and how to enter. Now I can see Alex said, what happens if the 30-minute bar gets a higher high after the pullback bars start counting? It just continues adding up. No, so the pullback candle occurs as we retreat from the extreme. So if this red candle were to go up and we make a new high, when we come back down, we're going to get a new candle. So the algorithm on pullback is all about, have we come back from the high or the low? You can start to blow your mind and think about, what about the pullback and the pullback, or the pullback and the pullback, or the pullback, but let's not go there, your brain explodes. What we care about is what's happening as I've come away from the edge. So that's something which we introduced in one of the library's clinics. I've gone through pretty much the same explanation here for the benefit of people that aren't TRG members, and also as a recap. But if you want to really capture this in your head clearly, just think of it as the auction within the auction. And I'll be referring to both pullback and also pullback delta in some of the setup examples later on. The next concept is delta at price. Now, on the left, I've got, reading from right to left, I've got a bunch of prices, 33.55 at the high, 52.75 at the low, whoops. I've got a footprint in the middle showing the bid and the ask prints at each price level. And then in the left-hand column, I have got the horizontal delta. So at the top, you can see 403 contracts minus 0 is positive delta of 443. At the very bottom, 0 minus 153 is negative 153. So I have got a column of values listing the delta, the net of the aggressive buying and selling at each price level. So this allows me to see what was the result of the battle around a given price. So I can understand, for any given price, was there more net buying or more net selling? And on the right, I'm showing the same data. I've actually got the delta at price on the right. I'm showing the actual numbers, but I'm also showing it in a histogram form, a delta profile that's colored according to whether it's positive or negative. So now you can start to see where there's big positive delta or big negative delta. On the left-hand side, the outlined rectangles are highlighting the largest positive delta, them highlighting red, and the largest negative delta, them highlighting blue. I'm doing the same thing in the candlestick on the right. So why am I doing this? Well, let's think about what these things tell us. And more importantly, what delta tells us based on where price is relative to delta. If we look at, let's use the, I'm just going to pull up my highlighter. Come on, Zoom. Yeah, Zoom is far too hard for me to use, even with my degree in computer science. Okay, we'll just try and visualize it here. Okay, so on the right-hand side, we have got you see the cursor, excellent, thanks PD. Right, 856 contracts. Here's the largest positive delta in here. And we're trading below it. This 856 tells me there were more contracts bought than sold. 2,500 something were bought, 1,705 were sold. The aggressive buyers were lifting the offer here. But the fact we're trading below where the aggressive buyers bought tells us that the passive sellers, the sell orders in the order book, the sell limits, they're in control. The buyers, the 2,500 odd contracts that were bought, didn't break through the inventory that was being offered by the sellers. If they did, we'd be up here somewhere. But actually, we're below it. So the passive sellers here won. Typically, what we want to see for a market that is orderly is positive delta above price, negative delta below price. Here, this negative delta is telling us that all of the aggressive selling, all of these contracts hitting the bid, is being absorbed by passive buyers that are very willing to buy at this level. So here we've got quite an orderly range. This is regarded as too high by people who are happy to sell. This is regarded as too low. So we've got a range that sticks out. Sometimes these will be the wrong way around. and it tells us we don't have order as represented by the limit order book. It's the market orders, the aggressors who are in control. Sometimes they'll be sitting next to each other. It's what I call a contested level. But if we can see large positive delta above us, large negative delta below us, and certainly consistent areas of negative delta below us, positive delta above us, we can understand where weight of passive selling or weight of passive buying is, and it defines ranges. Technical analysts would see this horizontally as, God help me, support and resistance. No, we've got passive supply, passive demand that market orders are unable to eat through. So here's a nice visual clue of understanding where there is weight of supply or weight of demand in the market. So that's delta at price. And we covered this in much more detail in our Delta Deep Dive clinic. Okay, patterns in order flow that allow us to identify reversals. This was covered in our clinic on meaningful patterns in footprint charts. One of my favorite patterns is a pattern called price rejector, which I've coded up commercially as an indicator, but I'm telling you how it works because there's no secret to it. Price rejector is a pattern that identifies when we are running out of aggressive trading. So we're looking at the top here. What you'll notice here is we have got exhaustion. As prices reach the top 3 levels within this candlestick, we're seeing fewer contracts lifting the offer. We've got 77 contracts, 1 tick higher, 72, 1 tick higher, 2. So in English, at higher prices, less people wants to buy. I can't be clearer than that. That's my dumbing down voice. Yeah. As price goes up, people are showing it's too expensive. Now, in English, I think we know what to do with that information. I've also got a diagonal bid-ask imbalance here, 36 aggressive contracts sold versus 2. That's what, 18 times imbalance. So as well as running out of buyers, sellers are getting aggressive. It's a finished auction. We'll get into unfinished and finished auctions shortly. But I've got a 0 here, which tells me that we've run out of buying. And look, I've also got positive delta. The buying is being absorbed by passive sellers. So in dumbed down English, as price gets higher, less people want to buy. Sellers are becoming more aggressive, and all the buying is being absorbed by passive sellers. We can't really ask for much more to tell us that right now, this range of 3 prices is too high. And that's why I call it a price rejector. Okay, David said, Lee, I've tried looking for this, but 1, either price moves too fast and I can't see it. 2, I need more practice looking for it. Well, yeah, you've answered your own question. Is this environment hard to catch it? When you get good at identifying it, you can see it. Or you can avail yourself of some fantastic tools that make it easier to see, and then you don't need to read it from the raw data. I like to read it from the raw data, but I will also apply tools to make this pattern easier to see. But let's, is this most useful to you on a 30-minute chart rather than, no, it is useful anywhere. The time frame of your chart is a function of the time. It's as long as you are consistent in the time frame that you are trading in, then the pattern holds true. And remember, as we went through that example on pullback, well, I can see here, I've got price rejector, I've got decreasing volume here, I've got positive delta, 536 minus 516, 496 minus 129. That's what, about 3 times imbalance. I can spot that here. If I'd filtered it based on here, I wouldn't see it. So it's a pattern that's valid wherever we're looking at, but don't take it here expecting it to play out for the rest of the day, because now you're looking on a 5-minute rotation. Does it work best on time-based? No, it just works. It's volume. How you choose to capture the volume in your arbitrary representation, that's up to you. And however you're looking at it, it's wrong. So a time-based chart, if we've got some structural time, like 30 minutes, yeah, we may well see it. On a range chart is not that different to a reversal chart, except we're spreading the reversal out over fixed horizontal distances bounded by range. So you will only see it at the ends of ranges. On a reversal chart, you will typically see it at the reversal points if those conditions hold. So it's not, does this pattern work best on a given type of chart? It's actually, how does a given type of chart affect how frequently you're going to see this pattern?
Can I jump in 1 second there, Lee?
Sure.
Because I think you answered the question, but I think there's another question there maybe.
Mm-hmm.
The best way to use this, in my opinion, is on a time chart. And tick charts give you misleading information when you use footprints with ticks, because you're consolidating twice. Same thing with ranges, which you pointed out. So David, I'm not sure what you're asking. I think the second question here is really, what's the easiest and best way to do it? And the answer is, from my point of view, time.
Yeah, I think time, range for me is a way of having very neat charts, but you can get a similar view to reversal. You're basically taking a reversal point and figure chart type, but splitting it horizontally arbitrarily. So you're wasting space. Tick and volume I pay no attention to, actually, as a chart type, probably because of the inherent filtering that's going on. And Bob has said lower on the candle, there's another similar pattern. Yeah, very good. There is. The absorption isn't so great, but well done. You've spotted the pattern in the volume of the exhaustion at the bottom, the aggression the other way. Would it be best executed on the next candle? Not talking about execution yet. We're going to get to, well, in fact, you remember at the start, we said, people will look for a signal on an indicator and just execute. So Bob, bad Bob, bad Bob. You have fallen into the trap of, here's a signal, shall I execute it? We are going to execute in the framework of our setups based upon favorable order flow. And this is just one potential tell of favorable order flow. Just because we see it, if I bring this up with no context of time, this is actually a 1 minute candle at 8:24. 8:24 doesn't fall into the framework of my setups, whether there's a price rejector there or not. So this price rejector I'm not executing on at all, because it's got no meaning to me. I'm only interested in the framework of a potential setup if I see a pattern that supports my trade objective. So that's a pattern to study, and it's in our library on the meaningful patterns in footprint charts. But something else to consider, I'm calling this the delta trigger. We can see at the top, we can identify this pattern across 3 price levels, and I contend we must have at least 3 price levels to understand exhaustion. If I go 77 to 72, this could be 900. I don't really feel I've got a confirmed view of exhaustion until I can connect 3 points in this line. So we have our price reject pattern across 3 price levels. Now, what I have got here, this 73, is the amount of delta, the net contracts that I'm saying are offside or trapped within this pattern. So the delta here is positive 2, 2 minus 0. The delta here is 36, 72 minus 36. The delta here is 35. 36 plus 35 plus 2 is 73. So I have got the platform telling me within this area, here's the quantity of contracts which are offside. This negative 18 is the delta of the pullback. I've got the pullback candle being printed here. It's ignoring the top price level because we start counting the pullback as we trade away from the price. So here, negative 18, because our print is 19 by 1, 1 minus 19. As we've traded 1 tick off the high, 18 contracts have traded. So what's interesting to me now is knowing 73 contracts are offside, 18 have come back in the market. So 18 to 73 have potentially puked. So there's an interesting potential trigger of saying how much of this needs to puke for us to get in. And I play this in different ways. Sometimes I'll see, if half of them puke, I'm happy to join in. So in the pullback delta, in this case would be around 35, negative 35, negative 36, I can take a view, half of this volume's gone out of this pattern. Now, it could be happening at this price level, it might be way down here, don't know, lots can go on. But I'm interested in assessing how wrong, what quantity is wrong, how much of them have bailed, and then when do I join in, going the other way? And that's the concept of the delta trigger is shorthand. I mean, that's not a great way of describing it, but it's a neat way of saying, I know how much is offside. I know how much is coming back the other way. Can I use these metrics as a trigger in order to now enter? So rather than just seeing the pattern and diving in, I could say, well, I see this pattern. When I get 2 ticks beyond it, I'm going to get in. Or I could really get finer and say, I understand what the pattern's telling me. I understand how much is offside. Let's see how much of this relinquishes its position. And now I can start to take a view using the pullback delta of when to join. There are different ways as well as to how much precision you apply to the price rejector pattern. We could say, well, I've got exhaustion, 242, 117, 73. 77 isn't that different. 73, it could have been exhausting from up here. I could be aggregating the delta. So I could say the net through this area is still positive. That minus 56, if I take a loose view of the exhaustion, doesn't really affect it. I could say I'm going to ignore the absorption, the delta at price altogether. So I like to be pretty strict on this pattern. I want to see strict exhaustion. I want to see aggression the other way. I want to see consistent absorption. Although sometimes on longer term candles, I will go for aggregate absorption through that. So it's a neat pattern, but there are degrees of discretion to applying it. And that's why, while I will use tools to highlight it, it's important as well to be able to read the raw data to take a finer view of what's going on. If we put hard filtered rules on here, we can miss some usable occurrences. So that's the price rejector. Unfinished business. So we did a whole clinic on unfinished business, one of my favorite concepts. Here we've got a candle, it's a 30-minute chart, 8:30, we've auctioned up, we've come away 1-2 ticks from the high. We don't have a zero here. I'm not going to go into the mechanics of why there isn't a zero, but if we do not have a zero on the bid at the topmost price, or if we do not have a zero at the offer on the bottommost price, it's an unfinished auction. That is telling me at the top of this candle, I don't care about the bottom because our rotation was up, we auctioned up. As we auctioned up, the lack of the zero tells me this price was not too high in order to run out of buyers. Because it was not too high, there's a likelihood we're going to revisit it because the market needs to find out where we will run out of buyers. The eagle-eyed amongst you will see that at 9 o'clock in our next candle, look at that, we got a price rejector. We had exhaustion, we had aggression, we've got consistent negative delta. The arrow here is telling me when the 426 contracts that are offside, 205, 187, 34, we went net positive, so all of these had puked by the time we got here. This is actually the basis of our B2A setup. This is a textbook example of an inside-out trade where we can cleanly identify a target. We have got a way of getting in. We've got our trigger, or we can use some discretion as to when to get in, and we know a minimum point of where we're going to. So I've spoiled a future attraction. Could you do the same on the bottom pattern? Okay, you just did. Yep, done and dusted, thank you. So I had a tell here of unfinished business, but what is important is to qualify when unfinished business is caused by running out of aggressive traders. We can see 851 is less than 2811. So it was exhaustion, we ran out. But sometimes there's instances of what I call a trade away unfinished business, which is when we've got massive absorption of buying, and the tell for me is a lack of exhaustion. So if this was, I don't know, 3,500, 4,500 contracts, way out of whack with this, then that is going to tell me it's not that we've run out of buyers, it's we had some massive passive seller who overwhelmed the buying. And at that point, I don't look to go back there anytime, quote, relatively soon. Michael, did my order flow package draw the orange arrow? No, I put the orange arrow in afterwards, the purposes of this presentation, but I do things on my platform where I do neat stuff like analyze these numbers, which are coming from my platform, and I will have signals appearing when the pullback delta compared to the trapped delta, let's use that phrase, breaches a ratio. So it is possible to set up platforms, Sierra chart, for example, to act on these metrics. I put that in to illustrate the concept. So unfinished business, two ways, Hoisin and Sweetentown. Two ways: we can have regular running out of aggressive traders or trade away if we have got massive absorption. Here's an example of trade away. So at the low here, 9:30, that's going to be the session low because we can't see the candle here at 9 o'clock. We auctioned down, whoops, slide went away. We auctioned down 654 is what, 150% larger. That's decently large enough. We haven't exhausted. Somebody here absorbed enough contracts to frighten everyone away. So while I would pay attention to this particular unfinished business, because it is occurring through absorption rather than simple exhaustion, I am less inclined to treat this as a magnet to be revisited anytime soon. It's still likely, but the fact we've got the absorption here from a large passive buyer gives me, I put less credence on the unfinished business as a potential target. I'm thinking much more, somebody here is chasing people away, I want to be on their side. And we can see how that played out in this example. And I go through this in much more detail in our unfinished business clinic. So that was a quick recap of the key concepts that I'm going to be using within the framework of our trade setups. So in terms of next steps, a recording of this is going to be posted publicly for our non-TRG members on Vimeo, but it'll also be a link in our library. Of course, you can review this. That's going to be in place by close of play tomorrow. You can, if you're a trading research group member and you haven't made it, well, watch this and enjoy it. Your TRG membership homework is to watch the specific clinics that go into these order flow concepts, about an hour, 90 minutes each. Just watch these ahead of not so much Wednesday, but certainly next Saturday's session, so that we can really start to embed the patterns in the order flow concepts that I'm using to evaluate whether or not we've got an opportunity within the framework of our setup. If you aren't a trading research group member, then we will be emailing a link to this recording to everybody that registered for this webinar. You can rewatch it to decide whether this workshop series is appealing to you, whether we seem to talk sense, whether there's value in 2 ES points for a month's membership to at least get this workshop, let alone everything else we do. There is homework, as I've set. And our next session will occur on Wednesday at the same time, where I'm not going to go through our setups yet, but I'm going to go through how I lay out my primary trading chart books. I'm going to explore the elements on them more deeply to give you an idea of how I'm assembling the data to make decisions. And I'll discuss alternative things that you can do based on your platform, based on the tools you use, or whether you want to make it more complex, less complex, or use your existing analytical techniques within the framework. So that's what we've got coming next. That's a pretty slide that shows I've run out of slides. So it's probably right to open the floor to questions, and for our non-members, that's where you'll find us if you would like to join us and do lots more of this kind of thing at this kind of level. So Jeff, if you help me out with the questions, let's see what we can do.
All right, I will do that. Excellent presentation, Lee. Thank you.
Thank you very much.
One thing I want to say just before I forget, you know, most of you who know me know I'm pretty much a scalper, which doesn't mean I don't take swing trades. It's just everything's a scalp until it proves itself otherwise. And I rarely look at other people's setups and add to my setup book. And the one thing, the exception to that in the last 6 months was I added unfinished business into my range trade, which is one of my setups, and it improved 2 ways, which was interesting. I don't know if I ever shared this in detail with you, Lee. I know we've talked about, but it improved 2 things. Number one, the win rate went up, but only slightly, because the win rate on that one's already pretty high. It's It's like 80 something percent. But what it did do, my scale in and scale outs were more profitable. So
Makes sense.
yeah, so the unfinished business is a good way, where you can think in bets, so to speak, on what's going on at those edges. And because they tend to be inflection points throughout the day, it's a really good filter to use, even if you're a really, really fast scalper like me. So anyway, let's go through questions. First of all, there's a couple things that came up. I'm just going to throw this out there. A question came up a couple different ways about, does the VIX influence your statistics on the initial balance breakouts at all? Have you tested that? Like, if the VIX is above, 50, do those numbers change dramatically? That was basically the question.
Yes, they probably do. No, I haven't analyzed it, but what I am planning to do ahead of going through the setups, I am not going to give you encyclopedic stats on these setups. I've got a good data set from 2018, 2019 on a few instruments. So ahead of each setup, I'm going to go, look, here's some basic rationale. And, it's 2013, that different to 2014? Probably not, yeah? And how valid do we want to be in terms of analyzing the validity of some of these hypotheses? But what I am going to do for each setup is I'm going to examine what's the past month been like on these same principles, because the nature of the trading has changed. And that's interesting to see to what degree do I'm going to say rules, but it's not the word I really want to use. But, to what degree do the behaviors change when the underlying nature of the market changes? So, of course, volatility and lack of liquidity, which is what causes volatility, has an impact. Would I use VIX as a scaling factor on it? Don't know. That's something interesting to look at, but I will, at a very high level, go, here's what March looked like. Let's compare March's stats on a few setups to 2018 and get a sense of, are things different?
Good answer. That makes sense. I had the same reaction you did. I was like, that'd be interesting to look at, and I bet it does affect it, but that's
and you can cut it different ways. Darren in our group, he said, does the size of the initial balance range have a determination on the excursion outside the range? So actually what would, if we looked at that ratio.
That one I've actually studied, and it does.
Yeah, and that is capturing the VIX.
Exactly. And this question's coming up right now in the chat. How do you determine how many ticks? Michael Glass is asking, and the point is, we don't. That was just a statistic about the past. What we do is we look at the energy of the break, and that's the order flow.
So on that table which I put up, how did I do that table in the way I did? I drew a histogram, and I was then looking at, did we have a normal distribution of excursions? No. Well, okay, where do I want to draw the line? So it's just playing with basic statistical concepts. I could have said 3 ticks, 6 ticks, 9 ticks, but you'd all hate me because we're trading ES. Yeah. So it's purely, let's put some boundaries in and let's decide, what buckets to use.
Good stuff. Okay, so let's see. Another thing that came up, and I just want to clarify this because there was a lot of conversation back and forth. Just to be completely and absolutely clear, when we use the term initial balance, it comes directly from market profile theory. And there's one of two ways that it's classically used. It's the first 30 minutes or is the first 60 minutes, the first TPO or the first 2 TPOs of regular trading hours. The time of day, forget it. People say, well, is that 9:30? Is that 8:30? Is that central? Is that? It is the first hour of regular trading hours. So if you're looking at New York, it's 9:30 to 10:30. If you're in California, it's 6:30 to 7:30. I just want to clarify that. It is not time zone dependent. It is whatever market you're looking at. It's the market that's dependent. If you're trading a European market, obviously you're not using New York or Chicago. You're using the regular trading hours of that market. Okay, just wanted to clarify that one. Other questions here. Let's see. Okay. This is a good one that Pavel just is asking Lee. So weak low is not a low with absorption, right? Question mark, exclamation point.
I fear PD is maybe jumping ahead here. And how, well, if we're talking about this IB range example setup, which I put in this deck, then there are several ways of which we can use to qualify whether the order flow is telling us that this break that might be 4, 8, 12 ticks or less is weak. So we might be looking at Delta divergence. We might be looking at massive absorption. We might have a price rejector. We might have unfinished business, but it's a trade away. Yeah. There isn't one answer. What we need to be able to do is read the order flow in several ways to think, okay, based upon knowing the statistics of what weak excursions are like and how far they tend to be, am I getting a tell from the order flow that gives me an asymmetric opportunity to go the other way and all the way to the other side? So it is a bit procedural, but I'm not saying it's weak because it's weak with absorption. It might be weak for many different reasons. Let's be open to different possibilities of what makes it weak and be able to identify that weakness and be able to act on it based upon this framework and our understanding of order flow. So I'm not saying if this, do that. I'm saying you have a likelihood of this occurring. If you can spot it, you might spot it in several different ways.
Okay, Lee, there was a question I missed, and I just want to throw it up before we forget it. Norman asked if there's going to be any discussion of edge zones, which is the emoji tool set, or
yeah,
if you're going to do that in the workshop.
So edge zones are all about aggression, and it's about how you can filter events in the footprints, looking at aggressive market orders, and it might be based on size, it might be based on the relative level of buying versus selling, it might be stacked imbalances, so aggression on cross consecutive price levels. Personally, I don't look at aggression, and the reason I don't look at aggression is, firstly, I can see it without any tools because the imbalances are highlighted. Secondly, if I can see it, everyone can see it. And if everyone can see it, I'm not that interested. It's happened, it's too late. So the way to trade with aggression, if you visualize them through edge zones as an example, is I like to think of them as potential stopping points on the way back. And we've got a clinic all about aggression where I do go through imbalances, which can be visualized through edge zones. I also go through lack of volume, zero prints. Or we wait to see what happens at the point where someone showed their hand. And that's the point on aggression. A lot of market orders that overwhelm the passive traders, the aggressive traders have shown their hand. If they've shown their hands, I'm not that interested. It's happened. That's why I really like delta at price and absorption, because it's harder to see. And I'm of the view that it's the, well, I'm of the view, this, here's the reality. What moves the market? Volume moves the market. So who's going to move the market most? Big volume. American Airlines fixing their price for crude for the next quarter. I want to be on the side of those guys who, in Dalton language, are the other time frame traders. And I'm not going to see them through aggression, because if American Airlines try to buy next quarter's crude at market, they're going to take oil up to $300 a barrel with their volume. I want to see how they're working their positions and accumulating or distributing. And then based on those clues, which I see in the delta at price and the absorption, then I want to align myself with what the other time frame traders are doing. So there's a long answer. Short answer, Norman, not really going to be covering aggression as triggers, but it is valid. If you are comfortable entering based upon shows of aggression, of course that works within the framework of the setups which I'm talking about, but we'll be entering at different times because we're entering on different signals and different tells.
Okay, good.
I was just saying, no, his question is also related to dynamic demands, but I think
Yeah.
he's talking there about an emoji-specific visualization. So what the emoji tools do, when they see an event in the order flow, they qualify what happens when the level is retraded to understand whether it looks like it's holding or whether it's exhausted and will break. So absolutely, that's a valid way of doing it. If we see an event in the order flow, like 3 price levels have shown aggression next to each other, then within the framework of a setup, if we retested that level and looked like it was holding, that's a good reason to go with the setup. Absolutely.
But again, the point is that you don't need a tool or a platform to see these setups. Any platform that gives you good order flow information.
Yeah, and for Norman's benefit and anyone that's coming to this from a tool, leads emoji and leads tool vendor,
right.
In my coaching, in my education, I maintain a Chinese wall between tools that I sell commercially and knowledge. I've got several private coaching clients who've now joined Trading Research Group. They'll all attest to the fact that I teach people to read order flow from raw data. Once you understand how to read stuff from raw data, you may well choose to avail yourself of tools to make your life easier, free up your brain and be more productive. But nowhere through this workshop am I going to say, in order to trade this, you need the Hokey 2000 indicator available only from emoji. That's not ethical. So I'll say, here's the pattern I'm looking for. Mm-hmm. If, like David, you find it hard, I'll say, well, it's a shame you find it hard, David. Work harder at it, or if you want an easy life, you can buy some software.
That's a really good point across the board with respect to tools. That a good trader can stare at the dome and trade with literally nothing else, but there's all kinds of stuff that can help you see the things that are that you're looking for more quickly or with less effort or whatever. But it's really important to understand that sequence has to go that way. If you go buy the tool set and you don't know what you're looking for, you're going to be perpetually just going from one tool vendor to another, because you're missing the sequence. Has to be, okay, I understand that setup, and that tool makes it a lot easier. I can do it with one eye instead of 3 now. So
you can buy a Ferrari Formula One car independently. You're not going to beat Lewis Hamilton at the next Grand Prix.
You probably wouldn't even be able to start the damn thing. Yeah, exactly. And it's just, and that's a point across the board too. I know we have a lot of people that aren't in TRG here in this session. You have to learn what is important as far as market structure and order flow. But then the other thing you have to do is find a tool set that works for you and master that as well. It still stuns me that people think they can just buy a piece of software, set it up over the weekend, and trade profitably on Monday. And that's just not reality. You need to not necessarily be a coder or an expert at Ninja or Sierra, but you need to be well past a casual user for it to work well. You really do. Okay, so let's see. I'm looking back through questions. I think we got them all. There was one thing came up, Lee. I don't know if you saw it as we were chatting in the text, but I think this is also good to know. In fact, you're looking at right now, the screen you guys are seeing has the library on it. And one thing we just did was this Chart to Dome boot camp, which was scheduled to be 4 sessions, but I think we ended up doing about 8, and it was great. And I hadn't even thought of this, but somebody said, well, can I watch those videos? And that was a special event. So the answer I gave, I just want to make sure you're aware and on the same page, Lee, as my partner, is that, any member could just add that for $49, right? And that.
The boot camp, yes. So even if you didn't attend Chart to Dome, you can still gain access to the recordings of that for $49. And in fact, what I'm aiming to do over the next 2-3 days is publish a pre-flight safety briefing video for new members that explains all the mechanics of how to work your way around Trading Research Group facilities. And that will also show, here's how you can purchase previous workshops and gain access to content that isn't group-wide.
Okay, I just was reading your comment to Summer. Yes, the recording link will go out.
Yeah, I'm not sure I said it, so shame on me for not saying it multiple times during the workshop. Now, I do see a question from Joe. It's valid. Why 60-minute initial balance versus 30 clearing range? Is it valid to look at both? That's
a great question. You saw my answer, so I'd like to hear yours. Yeah.
Well, I have a setup which we will go through. In fact, we showed a perfect example in the price trajectory example, which is trade B period to the edge of A period. So there are setups that say, what can we do after the first 30 minutes? There are also setups that say, what can we do after the first 60 minutes?
For people that don't know TPOs, the first 30 minutes is A, the next one is B, just to clarify that. A lot of people may not know what we're talking about with TPO charts. And,
True.
Yeah.
So we will look at setups of, inside out trades from after the first 30-minute range has been established. Is it viable to trade from somewhere inside that range to the edge of it? Then after the first 60 minutes range has been established, is it viable to trade from somewhere inside that to the edge of it? We'll be going through both of those next Saturday as well as one other.
There's a critical point there also. Let's see, I'm sorry, was that Joe that you were responding to? I'm looking
Yes.
back. Yeah, so Joe, there's also another critical point that's worth understanding. There's a reasonable amount of quote unquote economic news that comes out around the first half hour, which is why a lot of traders will some days discount it and some days not, simply just based on that.
And your point there about news and macro, I mean, that gets really interesting in the stats, and I'll be going through this as well in the later sessions in terms of your mindset on stats. When I'm doing the statistical modeling, how ridiculous does that sound?
You have to use a Furu voice for that.
Statistical modeling. When I play with my database, within my database, I'm also recording macro days. So, FOMC, inventories for CL, NFP. I also do things, I play the analysis of like, what if it's one day before FOMC or NFP? And let's look for these patterns. But, typically FOMC Wednesday will have what in market profile terms is going to be neutral day up until the release of the figure. So we know that, allow it to establish its range, fade the edges, and you'll get 3-4 bites of the cherry to do that. And this is about having a research mindset to your trading business, which thinking, well, if it's FOMC Wednesday, let's have a look at the last 12 FOMC Wednesdays and see what happens. Now, every now and then we're going to get something exceptional. We did 2 or 3 FOMCs ago. As I remember, there was a news release beforehand, and we just went wild. But a macro event, certainly a scheduled macro event, is going to take precedence over anything that happens in quotes in normal trading days through structure. So at the highest level, let's think, well, okay, the powers that be, they are good enough to publish a calendar of when they do this stuff.
Exactly.
So why don't we look at all the occurrences of when they do this stuff and look for what tends to occur and tune ourselves in? So, on the one hand, we look at economic calendars for must be flat a minute before, a minute after, otherwise Michael Patek's going to get upset.
Right.
Well, Mick in reality. Or we could be a bit smart and go, okay, what happened the last 12 times? What can I glean from that? How do I approach my trading day with that in mind?
There's a great pattern that's one of the ones in my database that I've been using, at least, I want to say 9 years, maybe 11 years. If there's any kind of significant event on an FOMC day, overwhelmingly, the odds are that move will be reversed the following day. It's better than 80%. So if you have just one of those announcements that was unexpected or whatever, just whoop, 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 all one direction, you can you can reliably fade that over the next 12 hours. So that's an interesting one too.
Provided you find a great entry based upon order flow.
Yeah, exactly. If you try to just pick a level based on resistance, you're going to get screwed, because there truly is a they that works against that. It's called, anybody that knows how the market works, any traditional quote unquote support or resistance levels just get crushed both ways because they're too easy to do that too. So, all right, let's see. Gold mines off because of the flu, maybe. Okay, I'm not sure I've heard about gold mines because I'm not sure what you're asking about there, Pavel. Could you try to reword that one and I'll take a shot at it. Also, Felipe, I just wanted to comment a little bit about the order flow in NinjaTrader. I'm using that really stripped down basic one because that gives me everything I need. As you know, people in the TRG know I dropped using MZPack just because it's not calculating accurately and it's too much of a CPU hog. So there is an opening out there for a more powerful footprint that has more advanced features, but I haven't seen a good one yet. And again, because I don't need those statistics, the imbalances and whatnot, I see them on the jigsaw domes. So I don't look for more than that. And I would encourage all of you, rather than going looking for a tool that has more parameters, to see if you can figure out a way to make it work with the tool you already have. Because a lot of times it's just a matter of retraining your brain. And the easy way is to go by the indicator, and that's not always the best way. And of course, I'm not referring to the emoji stuff. I'm referring to the Furu indicator world, algo box from Vinny or whatever, that kind of crap. All right, so what's the status of your Ninja footprint, Lee?
Coming. We've had indicators out for Ninja for a couple of weeks now. We're just going through the early phases of, how to put this nicely. We need to make sure things are very easy for more NinjaTrader users than the corresponding proportion of Sierra Chart users. So with a couple of weeks of indicators out there in the wild, we're seeing that. What I expect to happen is our full order flow suite, Emoji's full order flow suite will be out in 2 to 3 weeks, and then a free footprint for NinjaTrader will be out a couple of weeks after that. So probably give or take around a month's time.
Cool. All right. Well, I think the question Pavel's asking me now, I think I can answer it. I think you're talking about the news fade, and yeah, that is a different kind of idea. That if that's what you mean, there's a very consistent trade, just fading anything that comes across the tape that causes a sudden move of price discovery away from a range. And if that's what you're referring to, Pavel, that's similar, but the FOMC one happens over a longer period of time. So I kind of took it as a separate event. But yeah, any of the crap that comes across the tape during the trading day that's normal stuff, unless it's just earth-shakingly impactful, the vast majority of traders will look to fade those events because the people that are getting caught in them are stopping out. So if you just think about the upside down of that, as soon as they're done stopping out, whichever way they got caught, there's an opportunity there to scalp back the other way. And that's just a natural instinct of a scalper. Let's see, Joe, do either one of you trade the order flow around the imbalance events? We trade all imbalance events with order flow. That is by definition what we do. We don't look at certain times of day. We look at trading opportunities, Joe. So if there's an imbalance or an opportunity, the first place I'm likely to see it is in the domes on the market, and then I might go out to look at context if I didn't already have it in my head from what's going on the charts to understand how I might trade that. So I hope that makes some sense. But I mean, imbalances, in terms of price action, there's 2 ways to trade. One is when you're in the middle and there's value and everybody agrees, then there's trading from that point out, away from agreed value. And then the other approach is when we get to edges of the profile, as a lot of people refer to them. You see another form of imbalance in that people are trying to game the edge. And both of those, the keys are always in the order flow live as it's happening, and that's really all you need to see any of those if you learn how to see it.
To Joe's question, these imbalances announced those times, but imbalances of what?
Yeah,
I don't understand what imbalances are announced at 2:30, 2:45, and 2:50 Central. So if you can,
we'll give them a minute to clarify on that one.
Yeah, if you can clear that up, Joe, we'll speak to it.
Yeah.
But
I was basically just addressing the idea of order flow around anything, any sort of imbalance. But yeah, times, I don't look at times at all. So I don't watch the news either for the same reason. By the time it comes across any news service, the market's already priced it in. It's a total waste of money and time to have those live news feeds. No trader is smart enough or fast enough to respond to that. The market
and we've discussed this before as well, that when suddenly something takes off because of news, we've got no idea of what's going on and why. Money takes it, get flat. It's either working for you or not with you. But if something's going on that makes no sense, and if you're fortunate enough for it to be on your side, get out, because the market is working out what needs to go on, and you don't want to be in the middle of that.
Okay, there are no imbalances that are announced. You've been fed something. I'm not sure what you're talking about there, but
this is dark pool Furu.
Yeah, that's Furu crap, Joe. In other words, whoever sold you that or told you that, it's just nonsense. Yes, David, IBs work on any open of any market by definition. Will they work on stocks? Yes, but the problem with stocks is there's market makers in there and they can make the action artificial. So
And you're
everything,
not getting the whole picture because of
yeah.
other trading venues.
Yeah, you don't know what's on everybody's book. So stocks are a totally different universe and not a useful one for pro traders to use these kind of tools. So we focus exclusively on futures and like derivatives. And those all work that way, David, simply because of the psychology. When we're trading overnight, big traders can't play. There's not enough liquidity. There's not enough volume. When the regular trading session establishes itself, it's basically the footprints of everybody playing out as to what their intentions are for the day.
And to a couple of points here that have just come up,
Okay.
to David's point, Peter McLennan in Trading Research Group in Australia, he's trading Nikkei, the yen-denominated contract, using exactly these principles. So he's using time zone based in Oz to his advantage, and he's really using exactly these setup concepts based around market profile on MJNK in CQG symbology, and it's working well. You just pull up a market profile chart on your market of interest, and you'll get a sense as to it's not how orderly it is in terms of respecting market profile, but turn this on its head. It's how many participants in that market that can actually influence the market are using market profile. And if the profiles seem sensible and orderly, then these concepts apply. And that to there's a question from Matthew about numbers bars on NQ. Well, NQ is so much thinner. As I said at the start, I much prefer if I want to trade and scalp NQ and pick up $20 bills, I will use ES analysis on ES for my orientation of what to do in NQ, but treat NQ as a very different animal in terms of how it's behaving. And actually, if I put a 30-minute footprint on NQ, it's meaningless. If I put a 30-second footprint on NQ, I can do something with it.
Okay, let's see. Something just came up here. Michael, that's just nonsense. Somebody on YouTube apparently is saying that the initial balance is the overnight session. It's complete nonsense. Look, watching any trading education on YouTube or listening to Twitter, you're going to get a lot of BS, and people charge for the BS, but it's still BS. The simple thing there is just go to the source, read the book. Stettleman wrote a book on market profile. It's really clear when the initial balance is. So, it's important to really understand how much BS and nonsense and furu crap is peddled in this business. And that's why we are so set on no nonsense in everything we do. And I hope that makes some sense, Michael.
And now also Michael's also asked preference between 30 or 16-minute initial balance. The initial balance is 60 minutes as a definition. There are setups though, which we will go through within this workshop, which are based on the range of the first 30 minutes and the range of the first 60 minutes. But in terms of terminology, if we say initial balance, we mean the first 60 minutes.
Yep. Okay.
And to Bauer's question, could we do on earlier, because we see live how it works in real time? Well, no, I'm not going to do that because I can't pick the day when it's going to necessarily play out live in real time. So this really is an implementation workshop, how we go about doing this. What I am working on though is a way of starting to record examples of these trades with a bit of commentary based on my trading. So then they can be fed into the relevant channels within our Slack. But because, well, if I knew what the market would do on a given day so I could schedule a workshop, I could make a fortune. But my crystal ball powers are not so great on that. So regard this is implementation and theory. And then once you have the implementation and theory, you'll be able to relate to examples that are posted on the day when they occur.
Okay, just to clarify another conversation going on here. Okay, opening range. The opening range is an AKA, also known as, for the initial balance. Most of the time people use it, so it usually means the same thing. However, an opening range is not a specific term. It's colloquial. So, for example, in TRG, I trade an opening range 5-minute and the opening range of the 60, which is the initial balance. So, people can call a range whatever they want, and that's not uncommon. I've traded opening 15-minute ranges, opening 30-minute ranges. So that's a bad term. It's sometimes used interchangeably, but the correct one is the initial balance. Opening range, again, can be something different. Okay, Rand Squawk. Yeah, that's another one of those useless news services.
Oh, terrible.
Totally useless, waste of money, furu nonsense.
Rand Squawk has a bunch of young kids in London who are reading off a Bloomberg screen.
Nobody at Axia Futures would tell you, Michael, that the initial balance is overnight. I know the traders there. You misunderstood that if that's what you heard, because those guys there know what they're talking about. Anyway, we can go around circles all day. The initial balance is the first 30 or 60 minutes, commonly the 60. That's what we use. We'll leave it there. Okay, other questions does anyone have before we wrap up? This has been a great session. Thank you very much, Lee. Wonderful examples, and I'm looking forward to the rest of it, because this is stuff that as a scalper I don't pay as much attention to, and it's useful. There's a ton of misinformation out there. Most information out there, Matthew, is misinformation. That's why it's so important to understand what the reality is. Really, really important. And that's why we have this up on our homepage. Most people fail at this. It's not easy. There's no magic indicators. You got to work really hard. Thank you, guys. Thank you, Lee. Lee, do you want to any final
thank you
comment?
everyone for the really positive feedback. It's much appreciated, and it's nice when we put this material together that people do find it of value, because there is a lot of nonsense out there in the education world and the tool world. So for the non-members, I hope this has sparked your interest in Trading Research Group. If you would like to join us for the remainder of the series, please sign up, and we'd love to have you as part of the group. And for everybody else, next session is on Wednesday at the same time, where we'll be going through the data elements, and between now and then we'll have our weekly kickoff session, the Ides of Monday, tomorrow. So we'll see you all then. All
right. One quick, let's see, I saw something I wanted to answer. What was it? I forgot. Oh, well. All right. Thank you, everyone. And we will, I know what I was going to say, that in addition to this, for people that join, we should remind everyone that the library has now 450 hours and like 80 videos on all these different subjects. So even
in fact, to Alex's point, he's just put there, I'd like to see more videos of real trading. There must be 20 or 30 hours of you tape reading, Jeff.
Oh yeah, literally, Alex, any video, look at the library list. Anything that has the doc reads the tape live has me live trading. And so there's dozens of them. All right, cool. Thank you, everyone. I'm going to end the meeting here. We look forward to you joining us. And if not, good luck out there. Good trading. Be very careful to avoid the furus. They're dangerous.
Indeed. Good. Thank you, everybody.
Thank you.